Hello everyone, welcome to our third video based on the chapter Basic Accounting Terms. In this video we will learn about different types of accounts present and the rule of accounting, that is, the debit and credit rule applicable to each type. 1 year has passed since inception of Gada Electronics and there is multifold increase in transactions recorded in the books. Many new accounts have been opened and entries made in the same. On seeing so many accounts, Jethalal is confused and he is unable to find out whether his business is going into the right direction or not. He then goes to his CA's office to understand the different types of accounts and rule of debit and credit followed in them. Jethalal goes to his CA. There are so many accounts which have been opened in my books. I get confused whether I am making profit or not. Can you explain? CA. Sure. I will start with basic explanation of all these accounts. Great. CA starts with his explanation. The very first account he explains is a personal account. Now, as the name suggests, these accounts relate to individual or organization with whom Gada Electronics have direct transactions. If you remember the previous video, Jethalal had invested his money into his business. So his own account, which is also termed as capital account, is the personal account. Also, if you remember, TV sets were purchased from LG company. Hence, LG company account in the book is also a personal account. Also, TV was sold to Mr. Hathi with agreement of payment after 1 year. Hence, Mr. Hathi's account is also a personal account. In short, all accounts of all people or organization who in any ways enters into transaction with business is known as personal account. Now the rule of accounting is very simple. Debit the receiver and credit the giver. Going forward with example, when Jethalal will pay to LG company its due, LG company would be debited as it is receiving the money, so cash would be credited. Similarly, when Jethalal invested his money into Gada Electronics, he has to credit his account, that is capital account, and debit cash account. Now coming to another set of accounts, which is real account. Now these accounts records all the transactions related to asset or liability of the business. Again going back to our example, when Jethalal purchased furniture from IKEA for his business, he had created furniture account. Now this furniture is a real account as it represents asset of the business. Similarly, when Jethalal has taken loan from ICICI Bank for 3 years, over here also one account was created, loan from ICICI Bank. Now this account is also real account as this represents liability that is present in the business. For the viewers who want to know the meaning of asset and liability, they can refer to video as mentioned in the link below for clarity. Over here, the rule of accounting is debit what comes in and credit what goes out. When a furniture is purchased, furniture account is debited and cash is credited. In simple words, furniture is entering business and corresponding cash is going out. Also, when loan is taken from ICICI Bank, cash is debited and loan from ICICI Bank is credited. In simple words, cash has entered the business and corresponding balance which will go out because our repayment is created. Also remember, all the asset account will have debit balance as it represents those money which are brought into the business, and all the liability will have credit balance as it represents the money which will go out of the business. Also, real account reflect the position of the business at particular point of time, as it shows what are the assets that are present in the business and what are the liabilities it owes. Now coming to the last account type, which is known as nominal account. As the name suggests, These are fictional accounts to reflect the income and expense in the profit or loss account. In reality, these account doesn't exist. Again we go to our example. When Jethalal purchased TV set, here money has flown from one real account to another. Confusing? Let me explain. Suppose you have rupees 10,000 in your bank account. This money is your asset. Now you decided to purchase a mobile phone from it, and the price of mobile phone is suppose 10,000. Over here, your asset is not depleted. It just changed the form from money to mobile phone. Just like water changes its form from liquid to gas when it boils, over here boiling is the purchasing of mobile phone. Money was liquid and mobile phone is a new form. Similarly, in business also, when Jethalal purchased TV sets, he just changed his asset form from cash to TV. Now, how to represent this transaction in computation of profit or loss? A new account is created in the name of purchase, which represent all the transaction made to create the stock of the business. Similarly, when we sold the TV to Mr. Hathi, over here also asset is transformed to one form to another. That is, TV set is depleted and money receivable from Mr. Hathi is created. But in order to compute profit and loss, an account is created in the name of sales, where all the transactions made to deplete the stock from business is recorded. Another expense which Jethalal made was payment of electricity bill. Now in this transaction, one asset is depleted, that is cash. So where to record the other end? Here again a nominal account is created in form of electricity cost and represent in profit and loss. Now we will understand the cash conversion in business with the help of water state transformation at different point. When you start a business with cash, you have water in the liquid form. Now when you purchase a stock, you transform your asset from cash form to stock form. Just as you boil water, you transfer its state from liquid to gas. Over here, purchase can be seen as boiling activities. Further, when you sell the good on credit, asset is again transformed from stock to receivables. Just like cooling the gas changes its form to solid from gas. Over here, sale is the activity where asset is transforming its state. Further, when money is received from debtors, asset is again transformed to its original form, that is cash from receivable, just like melting of ice. In case goods are sold in cash sale, then no receivable is created and straight away stock is transformed into cash. Nominal accounts which will be needed to record this transformation of cash to stock and stock to cash will be known as purchase and sale account respectively. Hope you are clear with the different types of accounts and different accounting rules followed in them. If yes, then do like, share and subscribe for more videos. Also, in case of doubt, please email us into the mail ID mentioned below in the description. Thank you.